All right, so I'm Jared Kaiser, Chief Investment Officer of Buckingham Strategic Wealth. Thank you all for coming out this afternoon. So we got three of us that are going to tackle the topic today. I'm just going to do a quick intro here before handing it off to Savina, and then we've got Kevin Grogan, our Director of Investment Strategy, that's going to come up for the Q&A piece. We're thinking on the Q&A side, maybe we'll have 10 to 15 minutes. So in general, not a huge deal, but try to hold questions throughout Savina's talk so we can take those questions at the end. So it's great to have Savina here today on back-to-back sessions, being able to present some content that we saw at the Advanced conference on that topic that I know has been a big deal over the last 3 years of basically seeing a number of these premiums, particularly value, go through its struggles in the U.S. market and elsewhere. So we're going to be able to see kind of dimensional research teams work that Savina has certainly been at the head of basically taking a look at the value premium, seeing is there anything that's changed, how do we interpret this period, what does it mean on a go-forward basis, and then again on the back end we'll take questions. So with that, I will hand it off to Savina.
Thank you, Jared. So yeah, value premium. Lots of questions we've been getting over the last several years, and we are going to dive right into it by first kind of observing what's been happening. This is on year, the performance of value versus growth in the U.S. And as you can see, there's a lot of white bars at the end of the period, meaning growth stocks outperforming value stocks as we come to 2018. Well, this is on a one-year basis. What about longer periods? On a 5-year basis, we see that the recent past has been one of several consecutive rolling 5-year periods of underperformance. That hasn't been the only time we've seen such periods of 5-year underperformance. We've seen it in the past, in the 30s, in the 90s, and in the early 90s, late 90s, as David alluded in the previous session. And when we switch to 10 years, kind of the pockets of underperformance on a persistent 10-year basis shrink to 3 periods. The current one we've been going through, the one at the end of the 90s, and the one in the 30s. So the period we've been going through in the last several years hasn't been the only period in history with consecutive 10-year rolling underperformance of value versus growth, but it's certainly one of few in the history of the value premium. It's helpful to put this in perspective by looking not just at the value premium, but as we mentioned earlier, at the other premiums that we focus on in equities, the other reliable drivers of stock returns. So we are going to switch basically now to 4 of those premiums. On top is the equity premiums, U.S. stocks versus T-bills on a 10-year rolling basis. Then we have the size premium, the value premium, and we have less data on the profitability premium. So what do you notice here? The value chart is the same as before, just put in the perspective of the other 3 premiums. What's interesting here are 2 things. One, there are as many yellow bars underperformance for value on a 10-year basis is basically for the equity premium. And as we said earlier, if there's one premium most people believe in is the equity premium. Stocks, we expect them to do better than treasury bills because there is risk of losing capital, etc. But the other interesting thing I find in this plot is size, the size premium, small versus large in the US. Even just kind of visual inspection of that chart shows you something. The yellow bars for size, for small versus large, are actually more than the yellow bars for value or for stocks versus T-bills. Size, on average, small caps on average have underperformed on a rolling 10-year basis more frequently than value has underperformed growth. But what has happened in the last 10, 15 years? We've seen just blue bars basically for size. Size has been doing relatively well. And as a result, I haven't seen lately questions from clients about is size dead. We've seen them before, but not recently. Now, the more common question is value dead? And yes, we are used to going through those periods of questions about the premiums, their existence, their validity going forward. We do not brush off those questions, and that's the main takeaway I want you to take from today's kind of discussion. We actually do take those considerations seriously. We have a strong kind of theoretical economic basis to expect the premiums, as Marlena mentioned earlier. This is valuation theory for us, telling us that you should expect the size, value, profitability, and investment premiums in the data. But we do take seriously the questions, has anything changed in the economy, in the financial accounting data that maybe suggests we are not going about capturing those premiums the best way possible. So what you're going to see in this presentation today is basically different ways for us to examine those claims and see if there is merit in those claims. Should we change something about how we pursue the value premium in particular or not? So in addition to putting it in historical perspective for the US market, comparing to the performance of the other premiums, of course, we don't live in a world that's just US. There are other markets out there, and it's important to remember this all the time. So let's see the same thing, all four premiums on a rolling 10-year basis for developed markets outside the US. Looks different. Is it expected to see here? Do we expect to see again some underperformance here and there? Yes, we do, because even on a 10-year basis, it's not abnormal to see premiums negative, even if their annual mean is positive. And we do see some underperformances for small versus large, but overall, less underperformance for developed markets. And one of the reasons for that is also here we are pulling 20 plus markets together. So in addition to just long horizon, we have the benefit of diversification across different markets, and as we'll see later, the realization of the premiums in different markets varies over time. They don't move in lockstep across markets. Emerging markets, similar story. So we do see premiums vary over time, going through positive and negative periods across regions, US, developed, and emerging. This is the plot I mentioned in the previous conversation. Don't try to read any names. What we've plotted here is just the realization over the last 10 years of the equity premium, the size premium, the value premium, and the profitability premium across all 40 plus developed and emerging markets around the globe. The goal here is not to kind of be able to read the numbers or the names. The goal is to see that there is quite a bit of dispersion in the outcomes of those premiums across markets, especially when it comes to size, value, and profitability. And interestingly, with value, kind of ballpark, what you can see is that about half of the markets experienced a positive value premium over the last decade, and half of the market experienced negative. US is on the negative side, but as I mentioned earlier, Japan, for example, is on the positive side. And the markets that end up with positive size premium sometimes are different from the markets that end up with a positive value premium or a positive profitability premium. So overall, we do see dispersion not only over time in the outcomes of the premiums, we do see it within a given time period across markets. And that again speaks to the benefit of broad diversification across markets in the pursuit of higher expected returns in the pursuit of those premiums. Now we go to the stories. So this was all just describing and putting in perspective the performance of the premiums, but as I said, there have been a lot of questions why the underperformance of value versus growth stocks in the last 10 years. And we have taken a look at quite a lot of explanations. We'll bring here some of the examples of those explanations. If you have others and you want to chat about those and see if we've done research on them, let me know after the end of the session or in the Q&A, and we're happy to talk about more. But we have plenty here to show you. So let's start. We've organized them in teams because there have been so many, of course, explanations about the underperformance of the value premium. So first, we'll go into a profitability explanation. This chart, let's focus on the left-hand side first. So on the left-hand side, what we show is the 10-year average performance, annualized compound return of value stocks in the US, 12.9%. Historical average, if we go back to 1926 and compute the same kind of annualized compound return for value stocks, 12.7. So what do we see? Very similar performance of value stocks over the last 10 years as over the full historical period for which we have data in the US. What about growth stocks? Their 10-year annualized performance is 16%, so outperforming value stocks. That's what we are talking about here. But when we compare it to the historical average, we see that value has done much better than in the past. And what some people have said is that this is due to the fact that growth stocks have surprised us, all of us, the market participants, with much better than expected profitability, growth in profitability in the last 10 years. A lot of the big growth companies have kind of built moats around their profitability, not allowing other companies to come in and kind of take share in their markets. And as a result, that surprising, better than expected profitability has driven their prices even higher and led to the outperformance of growth versus value. How many of you have heard some kind of that story? Some? Nobody? Okay, some people. So we looked at that just out of curiosity. Obviously, you don't know whether you can do something with that information, even if that's the case in general. But we looked. And we looked in the US, but as you know, they mentioned, we like to look not just at one market, we like to use all the data we have available. So we looked on top in the US, then developed, then emerging. What am I showing you in yellow and green? What I'm showing you in yellow and green is the profitability, weighted average profitability of the companies that we define as value or growth over time, so that we can see, has there indeed been a trend going upward in the profitability of growth stocks relative to their historical average and relative to value? Has the spread in profitability grown in the last 10 years? What do you see? If we just look on the top at the US, do you see growth for growthy companies displaying an increase in profitability relative to value? Yeah. So if we just look at the US, that seems like a good explanation for the outperformance of growth versus value. What about the other markets, though? Do you see such a trend? Not really. Neither in developed outside the US nor in emerging markets do we see necessarily the profitability of growthy companies in yellow kind of go up relative to the profitability of value companies. So it doesn't seem that this is necessarily a good explanation for why growth has done better than value. Another actually point related to the argument about profitability was brought up by clients when I was giving this presentation recently. They actually reminded me about the other period, recent period, when we had growth consistently outperform value. When was that? 99, the late 90s, yes. What was the typical characteristics of growth stocks back then? Exactly, no earnings or negative earnings. So it was quite a different story back then about what was driving the higher returns of growth versus value. So while one explanation might seem to be the case in one particular outcome or decade or period, doesn't seem to carry over in another period. Oh, off to macroeconomic stories. And we have plenty of those, of course. So we have been looking at a bunch of them. I'm showing just a few here. Again, if you want to hear about others that you have been asked about by clients or prospects, let us know. We can certainly share with you some of that research or nice slides that we can show on the performance. So one thing, as I mentioned earlier, is there's been a lot of talk that because in the last 10 years we've been living through a low interest rate environment and low inflation rate environment in the US, that's been a decade kind of prone for success for growth stocks relative to value stocks. Why? Different stories thrown out. One story is that growth companies thrive in low interest rate environments because they need to borrow to fund their growth. Another is that value stocks tend to be kind of short duration assets, and growth stocks tend to be long duration assets. So again, low declining interest rates benefit the long duration assets more, the growth stocks. So we've looked at that. What do we have here? What we have here is scatter plots of the value premium as captured by HML. This is high minus low, the Fama French version of the value premium, versus different ways to measure interest rates. 10-year treasury rates, the actual rate, over 2-year treasuries and 3-month treasuries. So from longer term interest rates to very short term interest rates. What we wanted to see is on a monthly basis, is there a noticeable pattern, a noticeable relation between the value premium and different types of interest rates? Do you see a relation? Not really. It's a lot of noise. Lots of kind of positive realizations of the value premium when interest rates are low, lots of negative realizations, and similarly when interest rates have been higher over time. And we've looked at a long period, from the 70s, from some of the rates, or the 60s, to the present. What about inflation? That's the other macroeconomic variable that has been linked to the performance of the value premium. So this is US inflation against contemporaneous value premium, again, month by month. Annual inflation here versus annual realizations of the value premium. We don't see much of a relation. We developed that plot, by the way, in response to a lot of questions we got at some point recently about a plot developed by someone else, I don't even remember where and why, showing kind of inflation decade by decade and the value premium decade by decade. You might have seen that plot, and there was this beautiful relation kind of going up between value premium and inflation, showing that high inflation decade by decade is related to high value premium in that decade. The thing is, if you break it down into smaller periods, shorter frequency annual periods, you don't see that. If you try to see if the past decade of inflation or even the past year of inflation contains anything kind of actionable in terms of information about the subsequent performance of the value premium, no reliable relation. And this is a plot that Morlina and team created very recently. I like it a lot. It's related to another macroeconomic story put together about the underperformance of value, which has to do with where are we in the economic cycle. Now, we at Dimensional don't use the word the term economic cycle a lot, because it implies something has a cycle, something has a predictable pattern. As you know, recessions, ups and downs of the economy are very hard to predict. Actually, the NBER, the National Bureau of Economic Research, which defines going back in time recessions in the US, takes their time to actually pinpoint when is the peak and the trough of a particular period in the US economy. So it's very hard to actually identify, even going backwards, let alone forward, peaks and troughs in the economic development. But some people claim that now we are in the late period of the economic cycle, and as a result, this is a bad period for value. So value has underperformed growth stocks. So how do you go about looking into that as a hypothesis, testing that hypothesis? What we decided to do is come up with a definition of what's late in the economic cycle. Our definition was, well, you take the trough and the peak, the next peak, take the midpoint there, and the period between the midpoint and the peak we define as the late cycle in a period. So we are going down, up, and before the next down, we look at the kind of the last segment before the going down. We define those months that are between the midpoint and the peak as the late cycle, and we plotted in yellow the monthly distribution of value premium, and not only value, but also size and profitability in those months. And then we compare the distribution of outcomes of the size, value, and profitability premiums in those months versus the overall distribution across all months, no matter whether you define them as late, early, in the middle of the economic cycle. What do you see from the plot? The distributions look quite similar. Obviously, one is fewer months, so smaller, because we focus only on the late cycle months in yellow. But even the distribution in blue at the back, and apologies for gray versus blue, not strong contrast here, but very similar. So we don't see necessarily a different pattern, a pattern where, like in yellow, a lot of the returns are shifted to the negative side, let's say. We should say in the late cycle, even if you were able to identify the ex ante of an economic period, that value underperforms growth. We don't see that. Now we come to a bit more researchy explanations for the underperformance of the value premium, which we take actually even more seriously and we examine more thoroughly because they claim that maybe there's a better way to capture value because of changes, as I said, either in the economy or in financial data, reporting of financial data. And they mention is all about implementation. So if there's a better way to implement, to go capture the premiums and deliver them in our investment solutions, we are going to do it. But in order to change something in our portfolios, we need compelling evidence that it's worth changing, that there's a better way to do things. So with the value premium, as you know, the way we focus on value is by using price to book as the primary measure for value. And boy, have we gotten criticisms for just using one metric. Lots of them. All the index providers out there that I can think of use multiple metrics for value. Most of our competitors, if not all, use multiple metrics for value. We are probably the only firm out there that goes about capturing value and uses primarily one metric to capture value. What people, though, often kind of misperceive is that when we go about capturing value, that's all we do, let's say in a large value portfolio or in a small value portfolio. And that's not the case. We do incorporate, even in a small value or a large value portfolio, we do integrate a focus on the size and the profitability premiums as well. So we do take into account metrics like profits to book, even when we build a value strategy. And that comes and helps us in terms of smoothing out the right to higher expected returns even in a value strategy that is primarily focused on value, but by incorporating the size and the profitability premiums as well, that helps us provide a more consistent pursuit of the value premium and of higher expected returns. So just something to keep in mind. While I'm going to focus here on price to book is not the only metric we use when building value solutions. So one argument I've heard a lot over the years, not just the last 10 years, is that the economy has shifted, and that's a fact. The economy has shifted, has been shifting from manufacturing capital-intensive sectors to information service-based sectors. And with that, one line of kind of reasoning has been that as a result, book value, book equity on the balance sheet is no longer an adequate measure of the net asset value of a company. Why? Because there are a lot of intangibles that are being created these days by the companies, and a lot of those intangibles don't show up in book equity. How many of you have accounting background here? A few, okay. So you probably know that there is some merit in that argument, but there is also not completely full merit in that argument. Why? Because there are two types of intangibles, but I'm kind of getting ahead of myself. What are intangibles? Examples of intangibles. Goodwill is the most kind of common, but there's trademarks, copyrights, franchises, distribution rights, right? Client list, reputation, name recognition, yes, all of that is intangibles. Spending on research and development is intangibles. Computer software is intangibles. Some of those intangibles actually are on the balance sheet of the companies and do get reflected in book equity. Which ones? The ones? Purchase, yes, thank you. The ones you acquire in a transaction, when you do an M&A with another company, when you acquire another company, all of its intangibles do show up on your balance sheet. The ones that don't show up are the ones you do internally. When you develop internally intangibles, those get expensed through the income statement as R&D, for example, and they do not show up on your balance sheet. So what have we seen over the years when we've looked at intangibles? We are doing a big paper on intangibles, as you can imagine, is that the internally developed intangibles represent about 20-25% of the assets of a US company. And that trend has been kind of the typical ratio of internal intangibles to assets for 30, 40 years. What we've seen is a big growth in external intangibles we do show on the balance sheet that has grown over time from close to zero to about, again, 20-25% of the assets of a typical US company. So externally acquired intangibles, which do show on the balance sheet, have changed, evolved over time in terms of how much they represent of the balance sheet. Internal intangibles, if you try to estimate them, have basically stayed roughly the same over time, which is important. Why? Because if people say we've changed, the economy has changed, the economy has shifted to intangibles, more intangibles, and book does not adequately capture intangibles, then we should expect price to book as a metric capturing value versus growth to start deteriorating its explanatory power for differences in stock returns. What we show here is a plot that I wouldn't advise you to show to your end clients. It's beyond comprehension by most people who are not, economists, finance people, investors, statisticians on a daily basis. But what we are showing here is basically on a rolling 5-year basis, the ability of price to book to explain differences in stock returns. If the economy has shifted and price to book no longer is a good measure for capturing value, you would expect that the explanatory power of price to book would have gone down, 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 down. What we actually see is that the recent 5-year kind of explanatory power for price to book for returns is similar to the historical average. In blue is the US kind of rolling 5-year average, which starts much earlier in the 1930s, basically. And in developed markets, yellow line, green line, emerging markets. In all markets, we kind of see the explanatory power obviously fluctuate on a 5-year rolling basis, but current level for price to book is similar to historical average. Another way to take a look at it, this is a bit more friendly for most people, is to just look at the spread in returns between value and growth stocks across sectors. So in yellow, we have the value groups of stocks in a given sector, and in gray we have the growth group of stocks. Why is it important to look at sectors for this question? Because there are sectors that are much more focused on the new economy, the intangible heavy economy, such as, out of the sectors here, which ones? Tech and healthcare as well, yeah, they do a lot of pharmaceutical, biotech type companies. Yes, what do we see in general though, across sectors? Most sectors, you see on average value measured by price to book, mind you, outperform growth stocks over the long term, even in the heavy on intangible sectors like tech and healthcare. Now, do I expect value necessarily to outperform? I expect it to outperform everywhere, but I know that there is, again, noisy returns, dispersion in outcomes, so there might be sectors where, in a particular region and decade, where that's not the case, but over the long term, as a broad pattern, I do see value as captured by price to book do better than growth as captured by price to book. This is just a glimpse of the research we've been putting together on intangibles in particular, as I mentioned, now going kind of zeroing in on that question of intangibles, where we actually said, okay, let's try to estimate historically those internal intangibles that do not show up on the balance sheet and see, do they matter for sorts on value and profitability? So what you have on the left-hand side is profitability and value sorts for the US, all companies together, sorted either on profitability or on value. And what we see is, what we report here is the average monthly returns of group of stocks. For example, value, low profitability. Value, high profitability. Value, high profitability, average monthly return 1.3% per month over the full period. What we are looking at is, do you see value premiums in the different profitability groups of stocks? Yes, you do, and you see also profitability premiums across the different value categories when you use price to book and profits over operating profits over book to measure relative price and profitability. And that's consistent with valuation theory. Over a long period, we see positive value and profitability premiums. How do the numbers look like if we decide to go through this very computational heavy exercise of saying for each company, say a company incorporated started in 1970, I'm going to accumulate over time its spending on R&D. I'm going to accumulate over time a fraction of its selling general administrative expense spending that I'm going to kind of label as spending on name recognition, brand recognition. Put those two together, depreciate some of that over time, and label that internal intangibles. Kind of the accumulation of that over time, accounting for some depreciation, these are the buildup of my internal intangibles. If I have that number for every company every year over time, what I can do is I can adjust my price to book by adding those intangibles to my book equity. So now my book equity reflects not just external intangibles, but also internal. And I can also then, or I should, also adjust my profitability metric. If I'm saying intangibles are assets, internal intangibles are assets, then I shouldn't have them as expenses on my profits on top of the profits to book ratio. So if you account for intangibles both in the profitability metric and in the price to book metric, what do you see? We see premiums again for value. We see premiums again for profitability. And for me, kind of that number here is the spread in returns between value high profitability and growth low profitability. The two extremes of expected returns. The high expected returns of value high prof versus growth low profitability, the lowest expected returns within the market. The spread between those when you don't adjust for internal intangibles, 56 basis points per month on average. The spread between those two extremes when you adjust for internal intangibles is 55 basis points per month on average. Very, very similar. So it doesn't seem like adjusting for internal intangibles is going to change meaningfully what we know about value. But a big paper to come on that. This is just a little bit more on, by focusing on value and profitability. As I mentioned, we do focus on both types of premiums, no matter what kind of strategy we build. Do we manage to capture dispersion in returns between stocks in the US market and in other markets, sector by sector? So what we show here in bluish is those value high profitability stocks. What's their performance on an annualized compound basis, high expected return stocks, versus in grayish, the low profitability growth stocks, the stocks with the lowest expected returns. The question is, do we see a spread in returns between those two groups of stocks across markets, across sectors? Yes, we do. Last thing on the, last but one kind of exhibit on price to book as a measure of value, I switched something here. What did I switch? Back. So here we had US markets and then non-US and emerging using price to book as for the value metric. On the next slide, the top looks the same. It's the US using price to book for value. The next two blocks of data are using, instead of price to book, price to earnings and price to cash flow to measure value. So I'm replacing price to book with other metrics, price to earnings, price to cash flow, other common value metrics. Do you see bigger spreads in returns when we replace price to book with price to earnings or price to cash flow? Not really. Spreads are similar. If anything, they are a little bit smaller. And there's a reason for that. Price to earnings and price to cash flow give you exposure not just to value, but also to profitability, because you have price scaled by a fundamental that is related to profitability, earnings or cash flow. So if you just look at a pure value strategy over a pure value sort over the last 10 years, you're going to see that that definition of a value sort would have underperformed a definition of value that blends price to book with price to earnings and price to cash flow. Why? Because over the past 10 years in the US, value was negative as a premium. What was profitability? Positive. So if you have a blend of metrics that combines value with profitability, then that blend, yes, would have performed better than just price to book over the last 10 years. But not necessarily because price to book no longer captures value, just because that blend gives you a mixed exposure to value and profitability. This mixed exposure is not a bad thing. It's not bad to have an integrated focus on multiple premiums. As I mentioned, we already baked this into our portfolios by having consideration for both value and profitability when building them, but just not through the measure for value. We do it through kind of intentional focus on both premiums in the design and management of the portfolios. So that's, again, one of those slides you don't want to show to clients. The one of the slides that we want Marlene and him to translate into something easily digestible for most people out there. But what this slide says is basically if we run regressions, I'm going to use that word, of monthly stock returns on important company characteristics such as size, value, and price, book to market, and profitability, and then I add those other value metrics that people often bring up as earnings to price, cash flow to price, sales to price, or dividends to price. Do those additional metrics in green add value? Give me something above and beyond the information I get about spreads in average stock returns, the information I get from size, value, and profitability, the characteristics that we already bake into our portfolios, equity portfolios. And the answer is that if anything, either they don't give you any information. What we show here are T statistics. Generally, you want them to be greater than 2 if those metrics are positively, reliably positively related to returns on top of everything else. None of those green numbers is greater than 2 or 3. None is positively related to returns. And a couple of them are actually switch sign, become negatively, kind of counterintuitively, negatively related to returns once you account for size, value, and profitability. So in summary, all of that research seems to suggest that price to book is still a good metric for identifying value versus growth. And it is still the metric that generates the lowest turnover across different ways of building value or building a value focus in the portfolio. The other key takeaway is you do want an integrated focus on multiple premiums. Bottom up, taking into account how the premiums interact in the cross-section. That doesn't mean necessarily 1/3, 1/3, 1/3 size, value, profitability. This is not how we build portfolios. Because you have to understand the interactions between the premiums in the cross-section of stocks to be able to capture the best interplay across premiums in the most efficient manner. And that's why we build that, the portfolios in an integrated manner, bottom up, from the individual stocks up, not by just blending one series that's value, one series that's small caps, and one series that's highly profitable names. That's not the most efficient way to get exposure to multiple premiums. I'll just quickly go over that. Another argument we've been hearing about value underperforming, which is beyond, honestly, comprehension, is that because of the growing trend in repurchases, especially in the US market lately, somehow that has led to the underperformance of value versus growth stocks. Not clear necessarily why, because repurchases are just another mechanism of returning cash to shareholders, similar to dividends, identical in terms of what actually happens to the company. In both cases, market value and book value shrink by the amount of the cash outlay to shareholders, whether in the form of a repurchase program or in the form of dividend payment. So we should not expect any difference between dividend and repurchases. And we've had dividends in the US for a very long time. If we put dividends and repurchases together as total payout to shareholders, that has been quite steady over time, together representing about 4% of the underlying value of the companies in the US. So we haven't seen any major change in total payout to shareholders. Not clear why there should be any change in the performance of value versus growth because of that. But just to mention, we've looked into that as well. Now, obviously, finish with the explanations, but if you want more or if you have questions about others, we'll do it in the Q&A. Just before we wrap up the official kind of presentation, wanted kind of to show, okay, how often do we see negative premiums and what happens after negative premiums? Can we time the premiums? As I mentioned earlier, on average, on a 10-year basis, value underperforms growth in 15 out of 100 periods. So 15% of the time, value underperforms growth on a 10-year basis. 16% of the time. How often does this happen for stocks versus treasury bills? It's up there. 15% of the time, yes. The gray bar on top. That's awfully close to the frequency for the value premium. If there's one premium that is much more frustrating, that's the size premium. And yet no one has recently talked about the death of the size premium. They did a while ago. Why? Because just size in the last few years has performed positively overall. But wait until small caps start underperforming, we'll get the same questions for size. What happens after a decade of negative performance? How bad or good is it? Well, we looked in the history, again, no guarantee that it's going to be the same in the next 10 years, but after a period of 10 years of overall 10-year period of value, let's say negative versus underperforming growth or small underperforming large or stocks underperforming T-bills, what's the average performance of those three premiums in the next 10 years? On average, it's been positive. Has there been variation in the subsequent 10-year performance? Yes. Can we go through another 10 years of value underperforming growth? I hope not. But the answer is yes. So just putting it in perspective, I hope we are on the positive side, but there's no guarantee. And before I end with an anecdote, I'll show you that, which is another anecdote, I guess. Imagine we are in March of 2000. In green, what you have is the Russell 1000 growth, so large growth companies in the US. In yellow, large value companies in the US. This is their performance relative to each other on a bunch of looking backwards periods as of March 2000. 1 year, who is higher, value or growth? Growth. 2 years. 3 years. 4, 5, 6, 7, 10, 15, 20. You think it's hard now? This was in 2000. No matter what scale you look back, growth was doing better. Go tell people that on average, the value premium should be positive. That's not the end of that anecdote, that story. What changed here? Two things changed. The date, we are 1 year later, March 2001. What do we see? who was better on a 1 year basis? You can't see the yellow line, but it's kind of zero-ish. Value, 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 value. 1 year. And all of that performance, going back 20 years, changed. And before I conclude and we go into Q&A, just one quick story on that. Can you time the premiums? As you know, we don't try to time the premiums because lots of research shows that you cannot systematically say when value is going to do better than growth or small better than large. 2003, in the February of 2003, after those events, I was interviewing for internships on Wall Street with Lehman Brothers and with Citi. And something happened in the Lehman Brothers lineup of in-person interviews in New York. They somehow screwed up the schedule, I think, because I ended up talking to a guy who back then was the chief economist of Lehman. Won't name names. And he asked me some questions. I thought I wouldn't even make it, something of like, what would you invest in today? Something like that. I had no idea which sector, whatever. And, but then I ended up getting offers from both Citi and Lehman to join them for the summer. The thing is, I got the Citi offer first, so I kind of didn't know whether I'm going to get the Lehman offer, and I was like, I'm just going to go with Citi. So when the Lehman offer arrived, I was like, well, thank you very much, but I already said yes to Citi. Then I get an email from that guy, chief economist of Lehman, saying, I still have it somewhere in my Dartmouth email, only a fool would choose Citi over Lehman. True story. So with that, you can see chief economist. And by the way, what happened to that guy after 2008? Last time I checked, maybe a year ago, he was the chief economist of one of the biggest banks we have here. I won't name names. But anyway, very smart person with a PhD, but we can't predict things. They happen very, very quickly and turn around very quickly. So with that, happy to have questions with you guys.
So I'll kick off to one. I'm going to ask actually both Kevin and Savina this question. We didn't talk about it in advance. So I know one that I've heard a lot is, how do you speak to clients in terms of, I don't have 10 to 15 years to wait for value to show up? So you first, and then we'll go with Kevin.
Me taking the hard one first. Okay. Yes, I mean, if you have a shorter investment horizon, the chances of you experiencing value or any of the equity premiums is smaller. That's it. So how can you deal with that? There are a few ways in which you can deal with that. One is, first of all, have a diversified portfolio to pursue the premium. Because if you're holding just 5 or 10 stocks, your chances are even slimmer. Second, have a diversified approach across premiums, what I mentioned before. If you want to pursue higher expected returns over a 5-year or 7-year horizon or 10-year, don't just rely on one premium. Rely on all of them. We have several that we believe are likely to persist into the future, and don't just rely on the US market or any other market in particular. Be globally diversified. And then implementation. Don't let implementation costs eat the return you're trying to get.
Yeah, so I would just add a couple comments alongside that. So one resource we use a good bit is the percentage of time periods where the premiums are positive. So what you'll notice, even if you look at a 1 year or 1 month, or as we heard earlier today, even 1 day, over every stretch of time, you would expect stocks to do better than cash. You'd expect value to do better than growth. So even if your time horizon is super, super short, we would expect the premiums to deliver a positive return. So that's sort of one argument I'll sometimes make. But another way to address this too is looking at the client's plan to see whether or not they even need to incorporate tilts to the factors in order to achieve their goals. If they don't, then I don't beat people over the head with what we think is best. If they can have a more market-like portfolio, I think that's okay as well, if they can still achieve their goals and accomplish what they want to accomplish. But I will share our perspective, but if they don't want to go that direction, that's okay too.
Okay, great. All right, so we've got about 10 minutes or so. So any questions out there, Sam?
We actually have a study on that, or a couple of studies, but one in particular looks at past performance of the premiums. Can you use that for predicting the future performance of the premiums? The study was conducted by my colleague Jim Davis, whom you've worked long enough with him, you've met him and you've heard his name. He's the one who extended the book equity data in the US back to 1926 and allowed us to kind of look at the value premium going back to the 1920s. So a few years ago, he put together a study which is called Is There Mean Reversion in the Premiums? But it doesn't look just at negative relation between past performance and positive. That is, if value has underperformed in the last 10 years, is there a higher chance of value doing better in the next 10 years? He actually looked also as like, is there persistence in performance? And what you find in that study, looking at equity premium value, size, and profitability in the US, and then equity and value premiums outside the US in developed markets, not a strong enough relation anywhere to be able to act upon it in order to change your allocation to the premiums. Oh, okay. No, it's not a stupid question. It's in the market you have kind of, if you sort it on profitability and on value versus growth, you actually have 4 subsets, right? Value high prof, value low prof, growth high prof, and growth low prof. So we do have those 4 subsets of the market. What valuation theory tells us is that the highest expected return is for companies that are cheap value with high prospects for the future. So if you pay a low price today for something with high expected profits in the future, that's a very high expected return built in your investment. On the other extreme, on the flip side, if you pay a high price today for something that's expected to generate lower profits in the future, that's a very low investment return expected. And so what we like to compare is those 2 extremes. Basically, value high prof is the highest expected return corner of the market, look through the prism of value and profitability. Growth low prof is the lowest expected return. So we like to kind of look at the extremes. Growth high profitability is a subset of the market that kind of stands in between. It ranks lower on expected returns based on value versus growth because it represents growth, but within growth, it is the segment of the market with higher expected returns because it has higher profitability. And one kind of a little bit tangential comment on that is because of our research on profitability, we actually, 2012, so 7 years ago, eventually launched for the first time growth funds. Because that was the time when we saw that you can actually add value in a sustainable manner within the growth segment of the market by focusing on more profitable names within growth and improve the performance of growth stocks by distinguishing on profitability there. Small growth has done well relative to small value because of growth outperforming value in the last 10 years. So it has gone through like within small and within large, we've observed that in the US. Yeah.
Right. So so I think the best you can do on that is, as you learn about the client through the discovery process, try to figure out how they experience, what their experience was with their last advisor can be helpful. Like how often do you have discussions about performance? How often do you want to look at the performance of the portfolio? And the more someone wants to revisit specifically the investment portion of the performance, I think the less likely or less good of an idea it is to incorporate an extreme heavy tilt to the factors or to size and value. And so that's kind of one tell, but it is hard, I mean, just being candid, it is hard up front to know which clients will wind up being hyper-focused on investment performance versus those that won't. It is just very difficult, I think, to figure it out. And one thing I will say, something Larry Swedroe is very fond of saying, is try as best you can to not just pick the allocation for the client. Try as best you can to give them some ownership in the decision of what portfolio to be in, because there is strong behavioral finance evidence that says that if you pick the allocation for them and it goes well, then they'll feel like they were smart for picking you as the advisor. If you pick the allocation and it goes poorly, well, then it's your fault for picking the allocations. You don't get any credit when things go well. You do get the blame when things go poorly. So trying to get the client to buy into the allocation decision, and meaning that your role in that conversation is educating on the pros and cons of various decisions that the client might elect to take. And that would extend beyond just the investment portfolio, but also relating to planning-based decisions. Like I can't make the decision for a client whether or not they should buy long-term care insurance, but I can educate on the pros and cons and have them buy into whatever decision they ultimately want to make on it.
I'll add a couple things on that one. I think the well-funded piece is key there. I think one of the challenges that I see with that, if they're not well-funded, we're probably talking about very, very meager real returns from here on stock and bond portfolios that aren't tilted, maybe like 2 to 3.5% for a balanced portfolio. So I think it's one thing to say you're comfortable with that. It's a different thing to be 10, 20 years down the road and say, I've only outperformed inflation by, say, a couple of percent. So I think the capital markets environment is really challenging now, at least for people that stocks and bonds, no tilt, what are you really talking about after fees, over the long term, even for a well-built portfolio? Again, not a big deal if somebody's well-funded, but I think that's likely, to me, the return landscape that we're facing with where valuations are at currently. And then other thing I'd say, one thing that gets wrapped up into this, certainly the tilts amplify tracking error. But you also have to keep in mind, we've also had this US, ex-US thing going on that's been a big driver. Pretty much any degree of international diversification is going to introduce a lot of tracking error. So the tilts are going to kind of fortunately magnify that, sometimes to the good, sometimes to the bad. But the moment you have 30-40% of a client's portfolio internationally, which you probably should, that's at least a reasonable starting point, going to look a lot different from the US market basically year in and year out. Again, sometimes to the good, other times to the bad, like we've seen for the last 10 plus years. All right, any more questions? Probably got time for one more. Actually, we're right at 2:50, so no more questions. We'll go ahead and close up. Had one more? Yep. Yeah, the closest thing, I know the slide you're talking about, the closest thing we've got to that right now is we do show like some of the largest differences year by year, at least in the kind of the slide deck that we use for Buckingham and BAM that show basically for RT3, 2, and 1, I think what are the largest years of underperformance either relative to the S&P or to the globe?
It's relative to the S&P, and it shows the worst, like the most one-year underperformance, second worst, third worst, you can see. And so even to Jared's earlier point, even risk target 1, you can see, which is a pretty slight tilt to size and value, you can see double-digit underperformance relative to the S&P just because it's 40% ex-US.
All right, we'll go ahead and close there. Again, thanks everybody for coming, and thanks to Savina for presenting.